We saw a really strong Q4 GDP number come in, but I'm not quite so sure that the economy is as strong as everybody thinks and we've accomplished a soft landing. There could be some softness ahead. Let's go to the board and take a look. Today we saw the US GDP number for the fourth quarter come in at 3.3% on an annualized basis. That was much higher than the expected 2%. A lot of economists said, see, we've accomplished our soft landing. That's been the approach of Janet Yellen, the Treasury Secretary in the US. I'm not so sure, actually, but nevertheless, the 3.3% was a strong number for the economy. But let's dive into some of these numbers and take a look. So here we are. This is the quarter-over-quarter GDP number, on an annualized basis. You can see today's number came in at 3.3%. The previous third quarter, was 4.9%. That was really a bit of an anomaly. We've seen some numbers really in the 2 range. So this is actually a pretty good number overall. But let's take a look at some of the other numbers for the economy as well and try and get to footing on a feeling for how strong the economy is. Here's the inflation rate. Inflation rate is at 3.4%. We have seen some numbers in the 3 range quite consistently. This is well above target still. And this is what the Federal Reserve is actually concerned about, that inflation is quite sticky. And if they take the foot off the pedal here, that this actually could start to go back up a little bit. But nevertheless, we are seeing stability with the inflation rate. If we take a look at the unemployment rate, it's 3.7%. Now, that's actually a really good number. Typically in the States, you see a unemployment rate higher than the 3.7%, usually in the 4 range and into the 5 range as well. So 3.7% is actually pretty good. So all looks good, right? We've got a good GDP number. We've got stable inflation, still too high, but stable. And we've got a solid unemployment number here. So what's wrong? Well, there are other measures of the economy other than the big 3 that everybody looks at. I just want to show you one here that came out today. If we take a look at the activity index by the Federal Reserve Bank of Chicago. So this is a different way of measuring economic activity rather than the GDP. The GDP measures the sum of all the goods and services produced in one quarter, but there are other methods of measuring economic activity, and this is another one that the Federal Reserve has come up with. It's actually a pretty good indicator because it's tends to be more of a leading indicator rather than the GDP. It's a diffusion index, so it's a normalized series. It has a maximum of 1 and a minimum of -1 here. And the good thing about this index is the Federal Reserve has established that if we get down to a level of -0.35%, it's a fairly good chance that we're actually going to have a recession. And if we go back and take a look here, all the way back into the 70s here, we did see that occur, recession. Here across, didn't have a recession there, but it was shortly after we did. Then another recession here. There were a couple of false positives and then another recession here. And here we are, we've crossed this level of -0.35. And does it mean we're having a recession? Not necessarily. We could have another false positive as well. But the index has actually been pretty good at predicting an economic turndowns. But there's an important aspect to this. And that is, I showed you the graph earlier with the GDP being fairly flat, other than that anomaly of Q3 with 4.9. And then we saw the Q4 at 3.3. But if we take a look at this, look at just after the pandemic recession, we've seen economic activity actually going down. Okay, so that's been fairly consistent going down. So this is in contrast to what we're seeing in the GDP. So this could be an indicator that perhaps we have some weakness in the second half of the year, which could leave a window for the stock market to do okay in the next little while. And maybe we haven't achieved that soft landing, and maybe we didn't achieve the no recession scenario as well. But because right now this index is saying that things aren't quite what they're seeing with the big 3 that we always look at, the unemployment, inflation, and GDP numbers. Thank you very much for joining me today.